Welcome to our Savvy series. I'm Catherine Magano here with Rachel Ivanovich, and today we're going to continue the conversation about tax-related mistakes when receiving an inheritance. So one of the things that comes up is neglecting charitable contributions for tax deductions. So here you are, you inherit a bunch of money, the money comes to you, and then you're thinking, okay, what am I going to do? I have this extra money I wasn't really planning on potentially. And if you plan to gift some of that, there's some tax consequences you might want to consider.
So one of those consequences you have to look at, okay, where was the money before I inherited it? Mm-hmm. Was it in a regular living trust? Was it not in a trust at all? Or was it an irrevocable trust? And the reason this is important is because if you inherit appreciating assets such as stock mm-hmm. or real estate or something like mm-hmm. that, if it's in just a regular living trust or not in a trust at all, mm-hmm. it gets what's called a stepped-up basis. Yep. So you have to look at, okay, if I'm going to sell this or dispose of this asset that I just inherited, what's the tax consequence? Mm-hmm. So living trusts gets a stepped-up basis. You can turn around, sell it, no mm-hmm. tax consequence to you whatsoever. If it's in an irrevocable trust, you need to be really careful because those assets do not get a stepped-up basis. Mm-hmm. So therefore, you may want to consider something else, such as if you really wanted to give those assets to charity, you could maybe look into donor-advised funds or mm-hmm. something like that. If you don't know what those are, and to be perfectly honest, I haven't actually seen a lot of these in my career yet, mm-hmm. but they're basically flexible and tax advantageous ways to gift money or to give money to your favorite charities. So you take the money, you put it in an irrevocable trust, it grows tax-free, and it goes to your favorite charity. Okay. You get the tax deduction up front.
And once again, you want to look at, from a planning perspective, the money coming in, because yes. How is the money going to last for you? And then taking a step back to what you were talking about with when you inherit money, where is it coming from? If you inherit and it is from a trust and there's the step up in basis, and then you don't sell that asset right away, then potentially Absolutely. There could be a gain, either short-term or long-term. There's also some timing and making sure, like, when are you doing certain things?
I think that's a really good point, Catherine, because, when you do inherit that money and it does get the step up in basis, and so basically it's like a line drawn in the sand, so you have to make a decision, okay, am I going to hold that asset? Am I going to gift that asset? Or am I going to hold it for a year and a day? Because that will qualify you for long-term treatment, meaning you pay a lower tax rate. Right. So there's definitely room for a lot of planning when you inherit assets that can grow.
Yeah, it was interesting. We have a client that just inherited some money, or some actually stocks and bonds a couple months ago, and then here we are a few months later looking. They had the step up in basis, but there's a lot of gains in that short period of time. Yeah. And then that is actually now, if they were to do something, it's short-term capital gains. And then you can't just go off and do that because you have to look at, okay, what's the impact if you have Social Security coming in, you have other income sources, and that obviously could affect Medicare. I mean, there's a lot more to it than just, hey, I have this inheritance and I'm going to do certain things.
Right, and I want to sell this asset. Yeah. And, but then, like you said, I think it's really important because people don't realize that income's going to be taxed at the margin, meaning whatever that next tax bracket is, that's the tax rate you're going to be taxed on. So maybe you want to wait a full year and a day so that you get the lower capital gains rates, or maybe you want to take just a little bit at a time. Yeah. Or maybe if you're over 70 and a half, you can do what's called a qualified charitable distribution if it's from, let's just say you've got inherited an IRA and you want to take some money out of that. And as we talked about on previous podcasts, the rules for inherited IRAs are really complicated. So you want to make sure.
It's not as straightforward as you think.
if this is your situation, please call us, and we would be happy to talk with you. Our number here is 760-692-5520 is my direct line.
Yes, and the main line 760-692-5700. Once again, that's 760-692-5700.
But we really would love to talk with you about the tax implications of an inheritance, and not just the tax implications of the inheritance, but what are you going to do with the money? How can I utilize the money? How can it benefit me? So there's a lot of things that a lot of little tax loopholes that you can take advantage of.
Okay, so another kind of thing to think about is not setting up a trust for asset protection and tax efficiency. So once you receive the inheritance and now the money is, with you, do you have a trust in place? And if you don't, depending on the estate and how much you're getting, it might be something to consider, because now, once again, if you get the asset and if it's individual name or if it's joint, once again, or do you want it in your trust? So there's with that, the reason why you have a trust is to make sure that the estate is getting handled properly and smoothly. And what's interesting is we just worked with a client that they inherited some money from a grandparent, and everything went smoothly on, the mother was the trustee or the executor of the trust, and they ended up getting their portion, but they also realized that they didn't have a trust in place yet, and now they had these additional assets, and it was important for them to know going forward that they had their estate in order.
And many states have different limits,
yes,
so that your money doesn't go through probate when you die. You want to make sure, California, I think it's $160,000 in assets. You want to make sure that you have a trust set up.
And then we actually had another client we worked with this year that inherited some money. She came to us recently, and she wasn't the executor on the trust, but there was an annuity that was in a trust, and so she ended up getting some of the money from that. And so once again, there's some tax consequences, and then also some of the positions she inherited in kind. So you have to factor in, once again, if there is an annuity and some income coming in, there's some tax consequences there.
You need to call us before you sell anything.
I know. Please call us before you do anything. Exactly.
Because we've had several clients that have taken action and then called us afterwards and said, "How can you help us with this?" And sometimes there's nothing that we can do after the fact. I mean, there's definitely some other planning pieces that we can put in place, but please call us first.
Yes. So if your inheritance is big or small, obviously, or if you don't even know about it, it is part of your overall plan and retirement plan if you are inheriting some money. We actually had a client that we were working with earlier this year that was phasing into retirement, ready to retire, and then they received an inheritance, and which they weren't expecting at this time. They thought maybe in the future, maybe 5 or 10 years.
Changed their plan.
Yeah, and that changed everything. And so, once again, it's nice to have, but having those financial resources and professionals so they're helping guide you make those right decisions, that's what we're here for.
We also had another client who, and her parents, she thought they had everything in order, but all of a sudden, and she's younger, she's always lived, as she puts it, small, and reached out to us. She's like, I don't know what to do with all this money in these homes. Do I keep them? Do I sell them? And one of the homes was in a Roth IRA. And so these are, issues that we are happy to walk through with you, but really having somebody who understands the tax consequences, who understands financial planning. I think it's really important to have that person in your corner.
And then it's, obviously you're grieving from a family member too. I mean, there's a lot more to it, and everybody's different. Some people are very task-oriented. I want to get this done now. Some people that they need a little bit of time, but there are some. Obviously, there's some time consequences too because of some of the decisions and things that need to get done. But it's kind of case by case. Everybody's a little different too on how they want to handle certain situations.
So definitely reach out to us.
Yes. So if you want to call our strategy session with us, you can reach us at 760-692-5700. And thank you for joining us today and getting savvy about your finances. And we'll see you next week. Savvy up. Please stay tuned for important regulatory disclosures.
Savvy Women Wealth Management is an SEC registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.